So, as we head into 2026, some market momentum that we're seeing, should we be a little cautious though? Darren Thompson is joining us from Equity Trustees. Darren, good to see you.
Good to see you.
Now, of course, we've just had that Fed decision. Let's start at that point then. What you're seeing with global economic conditions potentially it's likely to shape markets going forward.
No, absolutely, and I think in the US things are delicately balanced, and I think that's some of the commentary from Powell was suggesting that striking that balance with inflation a little bit higher and still with some uncertainty around what the impact of tariffs and the tariff uncertainty will have on the US economy, and with a little bit of patchy jobs data. So striking that balance between resilience in the jobs market and inflation, I think will be key for central banks going forward. We would sort of sit with the markets expecting one more cut in the US over the coming 12 months, possibly more depending on who might be the new appointee later in the year. But certainly here in Australia, I think we're definitely on hold, although perhaps not quite as pessimistic around rate hikes as some in the market might be.
Well, certainly it's the inflation boogeyman, isn't it? Because that is spooking the Australian market, certainly spooking the RBA, you would argue. Less so for the Fed. There are other factors at play, clearly some political pressure going on there as well. So overall, looks as though perhaps global banks tilting towards a hiking bias. Does that then put the brakes potentially on the growth that we're seeing at the moment, certainly for EPS growth, for instance?
Yeah, I think certainly it probably is a bit of a cautionary tone. Markets were optimistic about cuts supporting valuations in particular and supporting those cyclical areas of the economy, consumer discretionary, home builders and the like. So I think we've definitely moved the needle a little bit from those cuts and extensive cuts back to at least being on hold, particularly here. And I think that will just be a little bit of a cautionary tone for markets. We still expect solid economic growth, both domestically and in that key market of the US. So I think it's sound. We've obviously got some stimulus coming through in the US through that fiscal support, tax cuts coming through in the first quarter of next year. That'll be supportive. So overall, I think monetary policy is still supportive, and fiscally, governments are still willing to spend to support growth.
But overall then, Darren, you're seeing perhaps likelihood that returns are going to be slightly lower than we've seen in previous years.
Yeah, so in terms of where our strategic asset allocation settings are, really after 2 to 3 years of very strong gains in the markets, I guess we approach next year with probably extended valuation. So a lot of that optimism is built into valuation, so our starting point is higher. And secondly, as we've just discussed, the interest rate environment is probably going to be less supportive than it was a month ago in terms of expectations. So those two factors, we think we will experience more constrained returns. And probably the third element is when we look at a lot of surveys, there seems to be a lot of bullishness. There's a lot of viewpoint or consensus around that solid, robust economic growth outlook there. So there's a fair bit of bullishness in market expectations. So the combination of those means that I think there's a little bit of vulnerability to any adverse news coming through.
Well, speaking of vulnerability, which sectors do you feel that are most vulnerable to the prospect perhaps of some rate hikes?
Yeah, certainly those where optimism has been built in, the growthier elements of the market. So there's much talk about the AI trade and sort of technology stocks more broadly. Obviously our market here has less exposure to that, but we've already seen some of that play out. Stocks like Xero and WiseTech have had a pretty material D-rating. And I think that might play out a little bit more over the next 12 months. So where we're more positioned is in more defensive sectors, a little bit dull, the Amcors, the Brambles of the world, if you like.
Would you throw in healthcare there? Because traditionally defensive, but that is really underperformed, isn't it?
Absolutely. So that's an area where expectations are quite low. They've been rebased quite materially, and that's an area where we've been adding to more recently because, again, relative to expectations as we go into 2026, there's been a fair bit of pessimism, in our view, built into the outlook for names like CSL, to a lesser extent ResMed, but others like Telix and so forth, which I think you mentioned a little bit earlier. We certainly think there is upside to those healthcare names.
What if you're looking for income? What would you advise those income investors, perhaps their strategy heading into 26?
Yeah, so global stocks aren't really a great place for income, and domestically, even the yield on the Australian market is sort of compressed to sort of 3.2 pre-franking. So it's not as great a place to harvest income. So where we are, ironically, the resetting of expectations around rates, I think, have reset real assets to reasonable values. So areas like property, like infrastructure, have actually sold off as the 10-year and interest rate expectations have moved up. So we think they're actually a decent place to play over the next 12 months. So property, real assets, to a lesser extent, even commodities, which we think will yield quite attractive returns.
Well, on that front, what do you make of the two largest sectors then? Commodities, which have been rallying hard, and we saw essentially a rotation out of the banks into materials. What are you making of those two sectors?
So really, we would see that if you look at banks, banks are pretty anemic growth. Really, when you look at it, credit growth is solid, but margin compression means there's very little top-line growth, and they're still working their way through the cost line. So bad debts are already structurally low. So our expectations for growth out of the banks are really fairly neutral. So reasonably steady earnings growth, and maintenance of dividends would be a good outcome. Conversely, we do see that solid economic picture globally is leading to some upgrades in the commodity space. Even iron ore is ticking up into 106, 107. Copper, as you mentioned, is quite robust. So we actually think relatively that sector certainly looks a solid place over the next 12 months.